Anand Tandon joins in to talk about the market. Anand, morning. We've got quite a push back since the levels we spoke at last. Where do you see the market headed over the near term now?
Well, again, as you mentioned, last 3 or 4 days it's been down, so it's possible that you may have a little bit of a bounce up again. As I heard Udyan mention a while back that you are looking at the global macro again taking center stage, and there is now talk of both revival of QE3 as well as a bailout of much bigger proportions in euro, which will again set the stage for a near-term rally. I mean, if you look at what happened with QE2 and QE1, at least in the US markets, immediately after that there was a 7 to 8% upswing, and then after that the market moved back again. So and moved back below what it was before the quantitative easing program was announced. I think that's pretty much likely again. There is, however, one small twist that is possible this time, that if you actually have a bailout where the debt in the Euroland is actually written off, I would imagine that would be a very attractive market from then on.
Anand, perversely, the only positive one can take away from all this news flow in Europe is that perhaps it will cause the RBI to pause its hand a little bit. On that count, are you more optimistic that maybe we're somewhere near the end of that interest rate cycle because of the deteriorating global news?
Actually, there is no particular reason why RBI should pause, because all said and done, we still have inflation way out of whack. And we still have negative real interest rates, and that's the point I've been making now almost ad nauseum for the last 1 year. Just because there is a problem in Euroland doesn't mean that there is anything which has changed substantially. If at all, the fears of inflation will now revive. In my view, if you do have a QE3 and a write-off of debt in Europe, there is more than likely that there will be a new gush of money, which will automatically take interest rates, perhaps make it softer, and invoke fears of inflation again. The only positive that we were looking at for the Indian market in the second half was that commodity prices would wane off, easing the pressure on margins. My fear is that this restructuring in the global markets may actually fuel another commodity rally, and that will again put pressure on corporate margins in India. So, I don't really see a case for reducing interest rates by the RBI. It may happen because of market forces.
43 up on the Nifty now, so it's stable enough, 55.70, and the Sensex up 135 points. Yesterday, one of the reasons for the pressure, Anand, was IT. How would you position yourself in IT as a space going forward?
Near term, I think it's still quite a challenging area, because the valuations are slightly, just not leaving much on the table, and clearly Infosys has shown that there is now increasing commoditization of the services business. The margin, the premium that you could charge for being a more reliable supplier is no more apparently being able to be charged by the large IT companies, and therefore, while that may be you may still be able to push volumes through because of the fact that the banking system in the US has actually recovered enough to start spending on discretionary spend. That doesn't necessarily mean that the margins can sustain very well. So, near term, of course, one is expecting TCS and perhaps HCL Tech to do reasonably well. But I think as a trend, if you look at it, I think premium pricing is perhaps going to be under severe pressure. And if the rupee again, were to start to strengthen for the near term at least, then that will add another currency pressure as well. So on both counts, I think the performance on the upside has to be somewhat subdued. That said, it may be the best place to hide right now, because if you are looking at a situation where money may become tight again, good cash flow companies are the best place to be in.
Anand, how would you approach this whole infrastructure space right now? Because they seem to be the favorite whipping boys every time there is trouble in the market. Aside of L&T, would you say it makes for a good contrarian bet, or would you still stay away?
Then the numbers are not very promising. If you look at the IIP as well as the order books that one is hearing anecdotally from many companies, the capital goods space has actually had a very poor last quarter compared to even previous quarter or the year before, and consequently that gives you some sign of worry that if infrastructure and capital goods segment is showing signs of lower investment, where will it lead from here? If you look at the last 3 years data, the highest kind of capitalization of fixed assets happened in FY10, and 11 is showing a downturn, and I think the downturn is beginning to look like it's going to exacerbate now in the next 12 months. So I think we are somewhat over the top in past the peak in terms of the cycle, at least for the near term. And while there may be some positives coming out because of new orders from let's say power plants and roads, I don't think that there is any shortage of capacity at this stage, which means that margins will remain somewhat subdued. So in the best of times, I think you're past the cycle peak, but on a market where there are some apprehensions about ability to raise capital or higher cost of debt, that will be the sector which will remain under pressure in my view.
You were talking